Welcome back to your Mortgage Minute by onlendhub.ca. We are joined by our mortgage expert, Muli. Today we are tackling the 2026 mortgage renewal cliff, where more than 1 million Canadians are renewing into a higher rate world and seeing serious payment shock. With the Bank of Canada holding its overnight rate at 2.25% and bond yields creeping higher, a lot of families are asking one question: what does this actually mean for my monthly payment at renewal? Muli, can you walk us through how big the hit really is and why June 2026 is such a critical window?
That is the right place to start. Bank of Canada staff estimate that roughly 60% of mortgage holders renewing in 2025 and 2026 will see a payment increase, with many 5-year fixed borrowers facing jumps of 10 to 20% or more. The peak in renewals hits in 2026, and a large chunk of those are borrowers who locked in ultra-low pandemic rates around 1.5 to 2% and are now facing renewal offers in the low to mid 4% range. With the overnight rate parked at 2.25% and prime around 4.45%, lenders are building in higher funding costs from rising bond yields, which is why fixed renewal rates have not fallen nearly as much as the policy rate. So the renewal cliff is real, but the exact impact depends on your balance, remaining amortization, and the choices you make before that renewal date.
Let us make that real for someone listening in Milton or Brampton. Can you walk through a concrete example of a typical 5-year fixed borrower hitting renewal this summer with actual dollars and cents so listeners can map it to their own situation?
Take a household that bought in 2021 with a $600,000 mortgage at a 2% 5-year fixed rate on a 25-year amortization. Their original monthly payment would have been about $2,540. If they renew in mid-2026 with a remaining balance of roughly $515,000 and accept a new 5-year fixed at 4.25%, keeping the remaining 22 years of amortization, their new payment jumps to about $3,360 per month. That is an increase of roughly $820 every month, or about 32% more than they were used to paying. If instead they stretch the amortization back to 25 years at that same 4.25% rate, the payment falls to about $2,770, which cuts the shock down to roughly $230 more than their original amount, but they are now paying interest for 3 extra years.
So framework number 1 there is payment shock versus amortization trade-off. Smaller payment jump today versus higher interest cost over the life of the mortgage. What would you say is the second big decision framework that renewal clients in the GTA should be using in this environment?
The second key framework is term length and rate path risk, meaning how much you want to bet on where rates go from here. With the Bank of Canada near what many forecasters see as the lower end of its neutral range at 2.25%, there is limited room for deep cuts unless the economy deteriorates. That makes a long 5-year fixed feel safe, but it also locks you into today's higher bond-driven rates for a full cycle. A strategic approach for many 2026 renewals is to compare 3 options on the same balance and amortization: a 2-year fixed, a 5-year fixed, and a variable tied to prime. You calculate the monthly payment for each, then ask 3 questions. Can my budget handle the highest of these payments? How likely am I to move or refinance before the term ends? And how comfortable am I with the risk that rates rise again if tariff or inflation shocks reemerge?
Let us dig into that with numbers. Using the same example borrower with about $515,000 remaining, can you compare a 2-year fixed, a 5-year fixed, and a variable so that listeners hear the actual payment differences?
Sure. Assume 3 renewal offers on that $515,000 balance with 22 years remaining: a 2-year fixed at 3.95%, a 5-year fixed at 4.25%, and a variable at prime minus 0.7%, which works out to about 3.75% with prime at 4.45%. On the 2-year fixed at 3.95%, the payment would be about $3,240 per month. On the 5-year fixed at 4.25%, we already said the payment is about $3,360. On the variable at 3.75%, the payment lands around $3,180. So the variable is roughly $180 cheaper each month than the 5-year fixed. which is about $2,160 per year of cash flow savings right now, but that discount can disappear quickly if the Bank of Canada has to hike by half a percentage point or more.
That brings us to the red flag side. What is one major mistake or red flag you are seeing right now among borrowers hitting that renewal cliff, especially in the Toronto area?
The biggest red flag is signing the renewal letter from your existing lender without running the math on alternatives or understanding the penalty risk if your situation changes. Many renewal offers default to a 5-year fixed with a standard big bank interest rate differential or IRD penalty structure, which can translate into penalties of $10,000 or more if you need to break the mortgage early due to a sale, separation, or income shock. A family in Milton that expects to upgrade in 3 years but signs a 5-year fixed renewal purely for the comfort of the lowest advertised rate could end up overpaying in interest and then writing a large penalty check to get out. On top of that, if they increase the mortgage amount or move lenders without understanding the mortgage stress test rules, they might discover too late that they no longer qualify under the higher of the benchmark rate or contract plus 2%.
You have already laid out two decision frameworks: payment shock versus amortization, and term length versus rate path risk. What would you put as the third framework, specifically for cash flow sensitive families who are worried about every dollar of that renewal increase?
For cash flow sensitive households, the third framework is what I call the 3 bucket cash flow plan: survival, stability, and acceleration. Survival means making sure your post renewal gross debt service ratio and total debt service ratio stay within a range where you can cover housing, other debts, and basic living costs without relying on credit cards. You start by taking your projected new mortgage payment, add property tax and heating, and compare that to your gross monthly income. If that ratio is creeping above 35% for housing or above 42% once you add all debts, you are in the danger zone and should favor lower payments via longer amortization or a shorter term at a lower rate. Stability means building at least 1 month of mortgage payments in a buffer account before you renew, even if that means diverting lump sum prepayments into savings first. Acceleration is the last step. Once you have 6 months of stable payments under your belt, you revisit increasing your payment or making prepayments to bring the amortization back down.
Before we wrap, can you give one more practical example, maybe for a variable rate borrower whose payments already went up during the tightening cycle and who is now renewing in 2026?
Consider a condo owner in downtown Toronto who took a 5-year variable rate mortgage in late 2020 with a starting rate around 1.5% and a balance of $450,000. Their payment may have climbed to roughly $2,650 by the peak of the tightening cycle as the effective variable rate moved toward 3.2% at renewal in 2026, with a remaining balance around $415,000 and a new 5-year variable at 3.35%. Their payment might only increase to about $2,700, which is a modest $50 bump because much of the shock already happened during the rate hikes. In that case, the decision is less about survival and more about stability. Do they lock into a slightly higher fixed payment for 5 years of certainty, or stay variable for potential small savings if rates drift lower? The key is still to run the 3 scenarios on paper, rather than making assumptions based on what friends are doing.
Let me pull this together for listeners. First, know your numbers. Map your current balance, remaining amortization, and renewal rate options so you understand whether you are facing a 10%, 20%, or 30% payment jump. Second, use the 3 frameworks we covered. Trade off payment shock against amortization length, choose your term based on realistic rate path and life event risk, and build a survival stability acceleration cash flow plan rather than reacting after the fact. Third, avoid the red flag of blindly signing your lender's first renewal offer. Compare options, understand penalties, and be clear on when the mortgage stress test applies if you change the loan or lender. That is it for today's Your Mortgage Minute by onlendhub.ca. Join us next time as we unpack another key decision in Canada's changing mortgage market.